The cryptocurrency world was abuzz with excitement. The U.S. Securities and Exchange Commission, or SEC, had finally approved the launch of several spot Bitcoin ETFs. This was a watershed moment for the industry. It meant that mainstream investors could finally gain exposure to Bitcoin through regulated channels. ETFs, or exchange-traded funds, are investment vehicles that track the price of an underlying asset, in this case, Bitcoin. They offer investors several advantages, including diversification, liquidity, and ease of trading. The approval of Bitcoin ETFs signaled a growing acceptance of cryptocurrencies by regulators and represented a maturing of the market. The launch of these ETFs was met with an initial surge in trading volume as investors, both seasoned and new, flocked to gain exposure to Bitcoin. However, the anticipated price surge did not materialize as many had predicted. The cryptocurrency market is complex and often unpredictable. To understand why Bitcoin's price hasn't skyrocketed, we need to delve deeper into the interplay of various market forces. The initial euphoria surrounding Bitcoin ETFs gradually gave way to a sobering reality. Bitcoin's price remained stubbornly range-bound. Despite the influx of ETF investments, the cryptocurrency failed to break out into a sustained bull market. This disconnect between expectation and reality left many investors puzzled. One key element was the overall macroeconomic environment. The global economy was grappling with rising inflation, interest rate hikes, and geopolitical uncertainty. These factors created a risk-off sentiment among investors, leading them to shy away from volatile assets like Bitcoin. Furthermore, the regulatory landscape for cryptocurrencies remained uncertain. Adding to the complexity was the inherent volatility of the cryptocurrency market. Even with increased institutional participation, these factors continued to exert downward pressure on Bitcoin's price. To comprehend Bitcoin's price stagnation, we must consider the broader economic backdrop. Inflation was surging to multi-decade highs, prompting central banks worldwide to raise interest rates. This tightening monetary policy had a ripple effect across financial markets. Investors tend to rotate out of riskier assets like stocks and cryptocurrencies during such times, seeking refuge in safer havens like bonds. This flight to safety exerted downward pressure on Bitcoin's price. Moreover, the ongoing war in Ukraine and escalating geopolitical tensions added another layer of uncertainty to the global outlook. These events fueled risk aversion among investors, further dampening sentiment toward volatile assets like Bitcoin. Bitcoin's price was caught in a tug-of-war between the positive sentiment generated by ETF inflows and the negative forces of a challenging macroeconomic environment. The geopolitical landscape was also undergoing a period of significant transformation, further influencing Bitcoin's price trajectory. The war in Ukraine had highlighted the potential of cryptocurrencies to facilitate cross-border payments and circumvent sanctions. This led some to view Bitcoin as a geopolitical hedge, potentially increasing its appeal during times of global instability. On the other hand, the very same conflict also exposed the limitations of cryptocurrencies in replacing traditional financial systems. Governments and regulatory bodies worldwide were reminded of the need to strengthen their oversight of the crypto market. This led to increased scrutiny and calls for stricter regulations, potentially hindering Bitcoin's growth. Furthermore, the growing rivalry between the United States and China played out in the digital currency arena as well. These geopolitical factors injected an additional layer of complexity into Bitcoin's price dynamics. Section 5. Regulatory headwinds navigating the uncertain terrain. The regulatory landscape for cryptocurrencies remained a significant source of uncertainty, casting a long shadow over Bitcoin's price prospects. The SEC, under its new chair, Gary Gensler, had made it clear that it intended to bring the crypto market within its regulatory purview. This meant increased scrutiny of cryptocurrency exchanges, stablecoins, and decentralized finance or DeFi platforms. While some viewed this as a necessary step to protect investors and ensure market integrity, others feared that over-regulation could stifle innovation and hinder growth. Different countries were taking varying stances on cryptocurrencies, ranging from outright bans to cautious embrace. This fragmented regulatory landscape created challenges for businesses operating in the crypto space and made it difficult for institutional investors to navigate the market with confidence. Until the regulatory fog cleared, Bitcoin's price was likely to remain volatile and susceptible to sudden swings. Section 6. The whales in the room. Institutional investors and their influence. The entry of institutional investors into the Bitcoin market was one of the most anticipated developments in the cryptocurrency world. With their vast resources and long-term investment horizons, institutions were seen as the key to unlocking Bitcoin's next bull run. However, their impact on Bitcoin's price had been more measured than many had expected. While some institutional investors had dipped their toes into the crypto waters, the majority remained on the sidelines. Several factors contributed to their hesitancy. Regulatory uncertainty, price volatility, and the lack of established custody solutions were among the key concerns. Institutions typically had longer investment horizons and were less likely to be swayed by short-term price fluctuations. The gradual, rather than explosive entry of institutional investors into the Bitcoin market explained why the price hadn't skyrocketed despite ETF inflows. Section 7. The psychology of the market: sentiment, fear, and FOMO. Beyond the fundamental factors, the psychology of the market played a crucial role in shaping Bitcoin's price movements. Sentiment, fear, and the fear of missing out, or FOMO, all contributed to the volatility that characterized the cryptocurrency market. The crypto market was known for its boom and bust cycles, driven in part by the emotional responses of investors. Periods of exuberance and hype, often fueled by social media frenzy, could lead to rapid price increases, creating a sense of FOMO among those who were not yet invested. Conversely, negative news or events could trigger fear and panic selling, sending prices tumbling. The psychology of the market was particularly relevant in the context of Bitcoin ETFs. When the anticipated price surge failed to materialize, it led to disappointment and a shift in sentiment. Understanding the psychological factors at play was essential for navigating the cryptocurrency market. Section 8. Beyond price: the true value proposition of Bitcoin. While the focus of the discussion had been on Bitcoin's price performance, it was essential to remember that the value proposition of Bitcoin extended beyond its market capitalization. Bitcoin was more than just a speculative asset. It represented a revolutionary technology with the potential to disrupt traditional financial systems. At its core, Bitcoin was a decentralized digital currency, operating independently of central banks and governments. This decentralization was appealing to those who distrusted traditional financial institutions or sought to protect their wealth from government interference. Furthermore, Bitcoin's limited supply, capped at 21 million coins, made it an attractive hedge against inflation. Beyond its use as a store of value, Bitcoin also had the potential to revolutionize payments. As adoption grew and the infrastructure surrounding Bitcoin matured, its value proposition was likely to become even more compelling. Section 9. A look ahead: what the future holds for Bitcoin. Predicting the future price of Bitcoin was a fool's errand. The cryptocurrency market was notoriously volatile and subject to a wide range of factors, many of which were impossible to predict with certainty. However, by analyzing the key trends and challenges facing Bitcoin, we could gain some insights into its potential trajectory. Regulation would continue to be a major theme in the crypto space. Governments worldwide were grappling with how to regulate this new asset class, balancing the need for investor protection with the desire to foster innovation. The outcome of these regulatory debates would have a significant impact on Bitcoin's future. The macroeconomic backdrop would also play a crucial role. Despite these challenges, Bitcoin's long-term potential remained intact. Section 10. Conclusion: a nuanced perspective on Bitcoin's price trajectory. The arrival of spot Bitcoin ETFs in the United States marked a significant milestone for the cryptocurrency industry. It signaled growing mainstream acceptance and provided investors with a regulated avenue to gain exposure to Bitcoin. However, the anticipated price surge failed to materialize, leaving many wondering why. The reality was that Bitcoin's price was influenced by a complex interplay of factors, including macroeconomic conditions, geopolitical events, regulatory developments, investor sentiment, and technological advancements. While ETF inflows had a positive impact, they were not sufficient to offset the negative forces at play. Looking ahead, Bitcoin's price trajectory remained uncertain. Investors needed to approach Bitcoin with a nuanced perspective, recognizing both its potential and its risks. Section 11. Disclaimer. The information provided in this essay is for general knowledge and informational purposes only, and does not constitute professional financial advice. The views expressed are those of the author and do not necessarily reflect the opinions of any specific entity. Investing in cryptocurrencies, including Bitcoin, involves significant risks, and past performance is not indicative of future results. Readers are advised to conduct their own research, consult with qualified financial advisors, and carefully consider their own financial circumstances before making any investment decisions.